Welcome everybody to come to our Bay Area Real Estate Town Hall Q&A webinar. Today is actually our fourth webinar, and I'm very excited with our two speakers because every week we pretty much have been inviting people who can talk about the hot topics of this week. And just to share this again with everyone is that we created this housing market town hall Q&A actually 1 week after we had this shelter in place in California, in Northern California. The main reason is that we had so much information on the market and then it just kept changing and changing. Obviously, a lot of consumers don't really understand what's going on. We have a lot of real estate clients who rely on us to give them information. So that's why it dawned on me saying that why don't I just create this town hall for consumers and also real estate professionals to answer all these questions. So that's why this was created. This is our fourth week. I'm really excited because we are able now to provide education directly to consumers. I do a lot of webinar, but mostly it's for our realtor communities, but I think consumers need to know as well. And this is information directly from other real estate professionals. It's not just from me, but it's a collective effort to share information. This way, then we can empower our consumers during this difficult time, because I know a lot of people just don't know what they're supposed to do right now. So this is a time for you guys to ask questions and for others to answer questions. And I found a couple quotes, and I've been really, I think we all have been stuck inside the house and we need some encouragement sometimes. So this quote says, the capacity to learn is a gift. The ability to learn is a skill, and the willingness to learn is a choice. So for those people today had joined our webinar, it is your willingness to learn, to hear from other people. Sometimes we always think that, oh, we probably know a lot already, but at the same time, even though I know people who have a lot of experience, they're still continuing to learn. And also individually, we're just one drop, but together we're an ocean. So with this town hall, it is a collective effort again from all the real estate professionals to share information, to provide this information for our consumers so that they feel like, okay, they have the confidence now to do what they're supposed to do, make the right decision for themselves. So if you're not sure what to ask, again, if anything real estate related, anything about your transaction, investment, housing market, buying or selling, or financing. This week, we have a few very hot topics. Of course, the 1031 exchange regulations update. So Weiming is going to be talking about that. San Jose rent freeze, they just had a meeting last night. So they passed the San Jose rent freeze until December 31st. And then now, state level, they have a proposal talking about 25% reduction on rent on the landlord. So now we're talking about how about the support for the landlords. There are a lot of obviously talk about like, oh, landlords should be okay, we have to protect tenants. I absolutely agree, we should protect the tenants, and a lot of landlords are working with the tenants. But at the same time, we have a lot of our clients, they are just small mom and pops landlords. So a lot of them don't qualify for PPP, the stimulus package, which you need to have employee in order to apply for PPP. And then a lot of them don't qualify for the EIDL program either. So what are the supports that landlords have? So we should, maybe it will be a good discussion to talk about it. And the lenders are also tightening the lending guidelines this week. So they've been news, a lot of lenders have been doing that. And then for those people who are applying for the stimulus package or checks, they wonder where they are. And of course, this is every single week. When is a good time to buy or sell? Every week people ask, should I buy or should I sell? Should I put it on the market? Should I just wait? And what will be the supply and demand once this shelter in place is lifted? So these are, I think, some of the questions that I know a lot of people have been talking about this week. And before I go into with the speakers, I want to share a little bit of the data with you guys. As you see, this is from Bay Area News Group. They've talked about, you see that the sold listings had gone down 9% in 2020 compared to 2019 for that 1 month period of time. And then you see that the new listings has dropped 19.6%. Obviously, we're not surprised, right? Because once the shelter in place started in March, a lot of new listings probably decide not to put it on the market. And then you'll see a huge surge on canceled transactions and withdrawn from market. This shows that a lot of sellers probably they did want to sell, but because of the shelter in place, they decided to pull it. And on top of that, real estate was at first was considered non-essential and then became essential. And then, there are a lot of different rules on how you can show. So that definitely had discouraged some sellers to put their property on the market at this time. So what will happen once the shelter in place is lifted? Will these properties where you see that's been pulled off the market, will they come back on the market? So that will be something that to think about. Another one is that from another webinar that I was watching, this is a breakdown on some of the industry that apply for unemployment. But this one, just want to note that this is based on only 700,000 employed statistics. So right now we have over 10 million people applied. So the next report come out, we will probably have a little bit different graph, but you see that the 60% is in food and service and drink places. And another large chunk will be a combination of child daycare workers, healthcare office workers, construction workers. A lot of them obviously got affected by the shelter in place. So what will happen to these sectors once the shelter in place is lifted? Some of the small business may not be able to come back, but then some of them may probably go right back into working, for example, dentists, some of the dentists or some of the more healthcare workers and child daycare workers, and as well as construction workers. So these are something that we should also think about as well. All right, so now I want to introduce our speakers. I want to really welcome and thank you so much for attending this webinar and answering some questions. Our first speaker is Weiming Peng, and Weiming, he has helped so many of our clients already on 1031 exchange. And every time we have question, we call him and he would answer in detail, answer every single questions we have. We put him on the call for an hour and he would be patiently telling us everything. I really respect that because you have so much experience and then you are just a really great speaker as well. So I want to welcome you to be one of our special guests today. And do you have something that you would like to say and maybe a little short intro and comments about today's market?
Well, thank you for having me on here, Helen, and thank you, everybody. You kind of mentioned a lot of the statistics already regarding where the market is right now, and it's all really similar for 1031 exchanges. We're seeing, clients who are uncertain about their 1031 exchanges. When I call up the clients or talk to the real estate agents, it's usually, hey, I think I'm going to delay, close of escrow, or I might, think about selling my property once this whole situation blows over. But a lot of investors are also have been waiting for the IRS to put out some guidelines regarding the 1031 exchange and how that's going to impact them. And as of last week, they finally did that. And even today, the Franchise Tax Board has released something to kind of clarify some of the questions. The IRS hasn't released anything further for clarifications, but I've been told that we should probably expect the IRS to release something to clarify their guidelines that they have released recently. And you want me to start talking about the guidelines and stuff like that?
I'll ask you questions in a little bit for sure. But it's funny because I remember our first week of webinar and somebody had asked you that question. I was like, so is there going to be an extension on 1031 exchange? At the time, there wasn't. And sure enough, now there is. So definitely we're going to have some questions for you on that. And it's Brian. Brian is actually a long-term client for Weiming as well, and he is an author, a speaker, and also a real estate builder and investor. And when I was reading about your bio, I was really impressed because you, I think you mentioned that you went from being broke to now obviously have executed over 100 million worth of real estate transactions, and you've been building and also created this system for a lot of investors to invest in Florida. And you also do a lot of speaking. You wrote a book. Is it 2 books or 3 books that you wrote?
I've written one myself, and I've been a co-author on a couple others.
I see. Yeah, and you have this book called What Matters Most, which is on Amazon. And I really appreciate you being here. And then, also especially you had gone through the 2008 mortgage crisis, so you know how to survive in one of these uncertain time. So we'd definitely love to hear from you. So, I mean, if there's anything, a short intro or some comments about, what's going on today, that would be great.
Yeah, so first of all, thank you, Weiming, for the introduction to Helen, and thank you, Helen, for the invitation to be a speaker on the webinar today. So I'm a student for life. I love what you said in the beginning, and that quote that you mentioned about, the people that are on the call are probably a lot of seasoned, very successful people. I always like to keep an open mind, and I'm constantly learning. I've been doing this business for 25 years. I started out broke, because as you mentioned, and as it says in my bio, and then our first portfolio, I know a lot of the listeners on the call are from the Bay Area. My first portfolio, I was actually living in Santa Barbara from the mid 90s until about 2006. And we built a portfolio in a market called Bakersfield, California, which everyone's probably heard of. Mm-hmm. It was considered sort of the joke or the standing joke of the entire state of California. But we loved that market. We were living in Santa Barbara, couldn't make cash flow make sense in the coast, and started driving over to Bakersfield in the mid 90s and bought a few hundred homes there and sold them at the top of the market between 04 and 06. As all the Californians know, the market went gangbusters in California between 2003, 2004, up through 2006. And we sold all of our portfolio there, which made us look really smart. We made millions of dollars at a young age, but then we made a huge, costly mistake of taking those millions of dollars and then plowing them quickly, using a lot of 1031 transactions and just moving the money out of one market into another. And we chose Florida because we looked at the fundamentals that probably every investor looks at: jobs and population growth and affordability and desirability and supply and demand. And all of those things were alive and well in Florida in 2006. But the biggest problem is that nobody saw fast forward to 2008, the world completely unraveled, the banking system went sideways. So we felt a lot of pain. We made millions of dollars, and we quickly lost millions of dollars by replacing and redeploying that capital into the Florida markets. So we sat on the sidelines from 2008 until about 2011, 2012. Stayed living in Jacksonville. It's a great place to live and raise a family. It's also very landlord and business friendly, which we can talk about later. All of those fundamentals is why we chose Florida. The timing was terrific for us, and we sat on the sidelines. And like I said, fast forward to today, we're blessed to having a really good business. We're providing a lot of turnkey investments for clients like you have on the call today. I am a full-time investor, so I just want to say that I'm only comfortable putting our clients into investments that we are heavily invested in ourselves. We have a very solid inventory of both new construction and existing resales in Jacksonville and throughout the state of Florida. And I'm just honored and excited to be with you guys, and hopefully we can we can add some value. And I'm anxious to also learn while I'm on the call.
Sounds good. Awesome. I think you guys both have so much experience. So, we have a list of questions up front already. So I will start asking questions, but if you guys have any questions at all from the audience, feel free to put it into Q&A. And as we see it, we will go in and then ask those questions from you. But my team, we all have so many questions pulled up already. So be ready for it. Now, okay, the first question for Weiming is that we know that there is a deadline extension for 1031 exchange with the additional 120 days for both identification period and exchange period. Is this something that 1031 exchange service need to apply for us, or is it automatically applies? Maybe you can go into a little bit about this regulation update first.
Sure. So I have it on another laptop, so I can read what it's been on our website as well. And it says, pursuant to notice 2020-23, if the end of a taxpayer's 45-day identification period or 180-day exchange period in a deferred exchange or parallel periods in reverse exchanges under the revenue procedure, 2000-37 falls between April 1st and July 15, the applicable period is automatically extended to July 15 or 2020. So your question kind of had a little bit of a two-part. So let me sort of explain. If your day 45, if you're in an exchange, your day 45 falls between April 1st and July 15th, it's automatically extended to July 15th. If your 180 days also within that period, again, also extended to July 15th, in accordance to notice 2020-23. What a lot of people are getting confused about is the 180 days. Clearly, this isn't an 120-day extension. It only extends to July 15th. And what a lot of people confuse is because there was a revenue procedure back in 2018. It's 2018-57, and it basically says, hey, whenever there's a disaster that occurs like this, you get an extension of 120 days. Well, people are confused now. There's the recent procedure says it's extended to July 15th. Does that mean I get July 15th and 180 days? Sorry, I'm kind of using my hands here. So that's where people are confused. Well, as of right now, what we're telling our clients is you only get the extension to July 15th until there is further clarification from the IRS that the other procedure also applies.
So this goes back to what we said earlier, is that during this whole time, like the past 4 or 5 weeks, things just keep changing. Regulars keep changing. They said like they give you something and then they later change the rule again. Same thing for the 1031 exchange. Right now they are saying, let's say if you sold something, you close on May 31st. So you have that 45 days time frame to about, let's say July 14, something like that. You really just get 1 day extension, right?
Pretty much. And if your 180 day happens to fall on July 15th, there's nothing in it for you, unfortunately.
Okay, got it. So this is automatic. You don't need to apply for it.
You are correct.
Okay.
May I just interrupt?
Sure, Jenny has a question.
Just a quick question. So hypothetically, let's say if I have a listing and it closes on July 14th, does that mean the actual identification period still falls within 45 days from July 14th?
You are correct. So if your day 45 is after July 15th, you get whatever date it is after July 15th. It's just, this only applies to clients who may currently be in exchange right now, and their date falls between April 1st and July 15th.
Got it. Thank you.
Great. But then there will be another 180 days. Basically, it's the same thing.
Well, whatever remaining 135 day as part of your exchange. So, you know, if you start your exchange, let's say today, your your day 45 would fall on
June. Oh, cannot hear you. Oh, we lost your audio. We cannot hear you.
Sorry. So if you started your exchange, let's say today, your day 45 would fall on next month on the 29th. And that happens to fall in between the guidelines. So it automatically gets extended to July 15th. And from July 15th onward, you get the additional or the remaining 135 days from your exchange to complete your 1031 exchange.
Got it. Okay, great. All right. So it says, since buying good deal properties could be easier now, so does it make sense to buy first, then do a reverse 1031 exchange afterwards? If that's the case, is the extension of days applicable?
The extension days are applicable in a reverse exchange as well. But in terms of when to buy your property, I can't speak on that. And especially with the lending terms being a little different than what we're used to, you may want to talk to your lender before sort of making that decision.
Sure.
Yeah.
Okay.
I can make a comment on that as
Yes.
far as buying. I think it's important to remind everybody on the call that real estate is completely localized. So for example, what I'm experiencing in Florida, in particular Jacksonville, Florida, where I'm headquartered, is completely different to what's happening even in Miami, 300 miles down the coast. So it's really important for, any investors that are considering investing at this time period now or any time period in the future to do your due diligence and make sure you understand that local market, right? Make sure you're getting connected with the right people on the ground there. Make sure that they're investors themselves, so they're not just speaking from a sales perspective, and that there's some track record there.
Absolutely. Absolutely. I absolutely agree with you in terms of very localized. Bay Area is very different compared to other part of the country as well. You have to look at the industry sector in each market. And that's why it's also important what you were saying about the market research. In the beginning, you have to look at studying the market about like the population, the employment, all that before you go in and invest, right? Okay, next question. There are a lot of investors who worry about selling their properties and can't complete 1030 exchange in time. What are the other options?
If they cannot complete their exchange, unfortunately, they do have a failed exchange. There is currently no relief for failing the exchange because of COVID-19. The only thing available is the extension, which I would like to say that if clients would like to opt out of the extension, they are able to do so as long as they tell the exchange company in writing.
What do you mean by opting out of the extension?
Well, in a 1031 exchange, there are certain guidelines you have to follow in order to get your monies back. In a 1031 exchange, if you fail to identify properties on day 45, you have a failed exchange and you get your money back on day 46. But on day 45, if you submit a list of properties, your ID letter to us, well, then you will have to complete your exchange within the 180 days. So even if you don't end up buying anything, you have to wait out the 180-day period, and then you'll get your money back on day 181. So for clients who want to sort of get their money back as soon as possible, they may opt out of the extension, hit that day 46 a little earlier, and get their money back.
Yeah, we did have somebody who came to us saying that they sold a property with another agent, and they made the ID within 45 days and decided not to purchase any of those properties. She thought she could pull all the money out, and it turned out she could not pull it. And I know I talked to you about that too, and that was frustrating for I know Marty, you have something you wanted to speak, and also Tim Tukalski as well. I unmuted both of you guys.
Yeah, I'll go ahead and go first. Just real quick about Weiming. I would think they would have the opportunity to identify like a Delaware statutory trust on day 44 if they wanted to, certainly. And if they wanted to opt out, they could also look at opportunities on investments.
Yes, absolutely. Those are still viable options for 1031 exchange clients. If they want to do DST route, they can certainly do that. I don't know if there's any requirement change for any of them at the moment, but I
can comment on that. The opportunity zone also got extended, so that was one of those that just came out. But the reality is there are some choices for people, but I like the idea that they have to act on prior to day 45 so they don't put themselves in harm's way.
Yes, sir.
Absolutely.
Thanks.
Thank you, Marty. And Tim? Tim Tukalski?
Oh. Can you hear me now? Sorry,
yes,
I didn't take
I
it
can
off.
Hear you now.
I was going to mention as well that the qualified opportunity zone is an opportunity for a failed exchange. So the way to think of that, I believe, is that if you have a failed exchange, it's treated as an installment sale. So if you have a failed exchange that, say, straddles a year end, you might be able to actually, or you're going to be able to treat that as an installment sale in the next following year. So the 180-day window, as Marty said, has been extended for qualified opportunity zones. But my sense is that on the date of that you fail an exchange, that starts the window for the opportunity zone investment. So you have 180 days after that date of the failed exchange. So day 46 starts the 180-day clock, and of course that won't end up within the window before July 15th, but you do have that opportunity. There is also a strategy for an installment sale, which I would like to warn people that you know, there's a right way to do an installment sale and a wrong way to do an installment sale. If the buyer is going to cooperate with an installment sale, then great, you can still defer that gain. Don't fall for, you know, a third party coming in and being the intermediary for an installment sale and then immediately turning around and loaning you that money. That is a direct violation of the installment sale rules and triggers the gain. You cannot use an installment sale obligation as collateral for a loan. They'll argue that it's not, but they've yet to provide statutory authority for that. So be careful with that.
Yeah, we can do a completely whole different segment just talking about Delaware statutory trust, qualified opportunity zone, and installment sales. But I agree with you, Tim. It's like it's very important to know that you can trust that company or process who offers that installment sales, because we hear so many people offering it outside, but it doesn't mean that you should just jump on it and do it. Make sure you have somebody you can trust to go over that first. Oh, Jenny wanted to know what is that installment sales? Do you want to explain a little bit further regarding the installment sale?
Oh, you're talking to me? Sorry.
Yes, sorry, Tim.
Well, so an installment sale is just basically anytime you sell property, capital gain property, and don't receive principal up front. So let's just say you did 100% seller carryback, or so sell a property for $1 million, take $1 million note. If you had the potential for $1 million gain, you have no capital gain until you receive your dollar of principal. So as you're collecting on the installment note, that's when you start to collect, pay your taxes based on your gross profit. You had 100% gross profit in the transaction. Every dollar of principal is taxed at your marginal tax rate. So you can switch it to an installment obligation in that situation.
Would you agree that there are a lot of, especially elderlies, when they have, owned their property for 20, 30 plus years, they have accumulated so much equity and they have gone over that $500,000 exemption on the capital gain tax. And that's when a lot of people will start, like approaching them saying like, you should consider installment sales.
Well, yeah, that's a whole other conversation to have about the elderly and installment sales. I jumped to the conclusion there is that if an older couple who sells property on an installment basis will not get a stepped up basis, their heirs will not get a stepped up basis on the installment note. So they'll be in a situation where the installment note is included in their estate. If they have a taxable estate, state pays 40% tax, and then the heirs will step in their shoes and actually pay the capital gains. So I advise a lot of my older clients not to do installment sales for that very reason. If they could just hold off, not sell the property, one of the couples dies, then they get a stepped up basis. So you
Yeah.
got to get that in older.
Exactly. So that's what I was trying to mention, is that elderly will be a target when they are selling their property with a lot of equity in it. So make sure if someone approach your client to talk about this, or approach you to talk about installment sales, you have to find a trusted advisor to go over the option to make sure it makes sense for you. Thank you so much for the input. Let me go to the next question for Brian, this specifically. In your opinion, how is this pandemic different from the 2008 global financial crisis?
Yeah, that's a really good question, and one I've been pondering and sort of thinking about a lot, especially over the last 6 weeks. As I mentioned earlier, I did go through that in a big way, the 2008 crisis. We had a couple hundred homes in Jacksonville, Florida that we owned, and then the GFC hit. So the true difference, in my opinion, and I don't have a crystal ball on what the next 30, 60, 90 days looks like, so keep that in mind when I'm answering this. What I do know is that the 2008 global financial crisis was a result of some fundamental flaws in our banking system, i.e., adjustable rates and the shell game that was going on in Wall Street. And what we're dealing with this pandemic is what they're calling something that's event-based, where none of us 45 days ago knew that this was going to happen, right? I mean, it sort of hit us from left field. So I am cautiously optimistic. Again, I do not have a crystal ball. I believe that we will move through this temporary crisis, or this event-based crisis, as they're calling it, a lot quicker than we did the 2008. I mean, the 2008 crisis went on, depending on who you're talking to, for a decade, right? I mean, there's some investors that are still cleaning up a mess from a decade ago. And I know from, friends and family and investors that I've talked to recently about that. What we're dealing with this pandemic is event-based. It is definitely going to have a huge impact, I believe, in the short term on our economy. As Helen already stated, what do we have? Something, I don't know how many millions of people filing for unemployment in a very short time. But I do truly and honestly believe that because of the things that have been put in place, and some states are very, very aggressive, like California. A lot of the West Coast states were further along in having people stay at home, identifying their essential businesses. And I think that we will move through this in a much quicker fashion than we did the 2008 crisis, because there was a fundamental flaw in our banking system there. This has nothing to do with our banking system. Is it affecting our banking system? Absolutely. I'm not a Pollyanna, but I also am a realist, and I'm also cautiously optimistic that that I think that we will get back to business as usual. I just don't have that crystal ball to tell you when. I don't think it'll be a decade from now. I don't think that it'll be 30 days from now, but I think it will be sometime later on in the year. And that's just my answer is my opinion. It doesn't make it right or wrong.
Absolutely. That's the thing, though. Right now, no matter who you talk to, even the economists doing all this data, they just nobody really have this exact same scenario, right? I mean, our employment is shot through the roof. Nobody had experienced that before. And then we have Goldman Sachs been talking about, V-shaped recovery. A lot of economists been talking about that. But at the same time, no one is going to tell you this is for sure it's going to happen. I think it's more important for us to really look at our local market individually. And but at the same time, I've gone through the 2008 financial crisis as well, and that's actually when I started investing, because I didn't do any investing before that, and I started in 2007. And I always say every crisis has opportunities. So at that time, I was able to pick up properties, negotiate a lot below asking price. So it was interesting. And then technically speaking, the recession was only for 2 years, but for us here in California, we didn't really see the recovery until 2012, which was about 4 years long. So, but right after that, in the Bay Area, all the pricing had obviously gone up above and beyond the 2006 level already at that time. So I'm just curious, if somebody asks you about, investing now compared to, back in 2008, would you say how would you handle it? How would you view it? And in terms of the strategy to invest during this time?
Yeah, so I actually have a very active sales business right now. I'm a full-time investor and landlord, but we also do provide turnkey investments. And I'll be honest with you, I mean, the numbers don't lie. So I expected a huge problem come April 1st, right? March was sort of a big question mark because this thing really got its headway mid-March. Our numbers in March were the strongest that we had in 2020 from a sales perspective, from a rental perspective, because I get reports all the time from our management company. We manage 2,000 plus stores across the state. And I'm always looking at the data, right? Because the numbers don't lie. And so I just got a report 2 hours ago because I knew I was going to be on this webinar and I wanted real up-to-date information for April, because April is really the true telltale, right? I mean, we're in full swing of this pandemic, and a lot of the states, the curve is going down now and they're coming into some type of recovery with less people having COVID. So again, I mean, I just pay attention to the numbers. It's totally different, in my opinion, than what happened in 2008. This is event-based. And I see it, to quote what you just said, Helen, it's not a crisis to me, it's a complete opportunity. I mean, in 25 years of doing this, I've never seen 30-year money for investors in the mid threes. I mean, I just got an update from my Wells Fargo contact this afternoon. 30-year money, 20% down. My investors are locking in at 3.875 on 30-year money. So what that does to your cash on cash returns, if you're a long-term buy and hold investor, again, this is not a quick get rich quick scheme. This is, sound fundamentals, getting into markets that are solid with jobs, people moving in, affordability. The interest rates have a huge play in whether it is a good time or not to get in, and understanding the market that you're getting into. Again, keeping in mind that I'll probably say it multiple times over the next hour, that real estate is completely localized. For example, even in Jacksonville, where we're invested full time, there's probably a 8 to 10 submarkets within Jacksonville, because if you're out at the beaches, I feel like it's a more mature market out there. I don't think it's a good time to buy out there. But if you move closer into the city where it's much more affordable and you have these starter neighborhoods with working class families as your tenants and buyers, it's a phenomenal opportunity to buy. So you just really have to understand the market.
Yeah, absolutely. And, for when I was investing in 2008, the interest rate was 7% around there. Yesterday, we were just talking to another client of ours, jumbo loan. He is getting 30 years fixed for 3.25 and 7 years arm 2.625. I was like, oh my gosh, you have to take this because it's amazing mortgage rate right now.
You're borrowing money lower than the inflation rate. I mean, it's, again, I've been doing it for 25 years and I've never seen anything like it.
Yeah, exactly. Jenny has a question. How should investors do due diligence when financial statements from sellers' performance will look very different moving forward? For example, a rent delay, possible rent adjustments in order to secure tenants. Will this rental income ultimately affect the listing price?
So is that a question for me?
I think so, yes. Sorry, yes, she said for Brian.
Okay, and the specific question is what, just so I make sure I'm answering her direct question?
You want me to repeat the question? I'm sorry.
Yeah, could you please?
Okay. She said, how should investors do due diligence when financial statements from sellers' performance will look very different moving forward? For example, rent delay, possible rent adjustments in order to secure tenants. Will this rental income ultimately affect the listing price?
Yeah, it's a good question. So again, I can only speak from the experience that I'm investing in with our own money in our markets. And again, going back to the numbers, we're doing a lot of build to rent brand new construction homes. So there is no rental history, right? We can only go off of rent comparables, and we have obviously a lot of sales value comparables because we've already sold a few hundred homes in that area of, say, Jacksonville or Ocala or Palm Coast or wherever we're building. So how do you mitigate that? I think it's just really doing your due diligence and understanding who is selling you the product. Most importantly, after that is, and probably more importantly than that, is who is the management company, the ongoing management is the backbone and sustainability of the entire investment conversation. So for us, I don't handle personally the day-to-day of the management, but I help our clients for the life of the investment. Once we get them into the investment and they close on the property, I continue, myself personally and my team continue to get weekly reporting for not only my personal portfolio, but for all of our clients for the life of the investment, so that I can step in and help mitigate ongoing maintenance, all the things that normal landlording deal with. But again, Florida's I don't want to paint it as a perfect picture, but it's about as good as it's going to get, because you're in a landlord-friendly environment. We are moving through recovery, meaning that we went through an up and a down in the crisis, like I mentioned before, but we're consistently and stably having growth year over year. If you just Google, I mean, you guys can use the internet, you can do a lot of due diligence online. Jacksonville, for example, where we're headquartered, has experienced 4 to 6% compounding growth. If you look back from like 2015 to today, very consistent, stable 4 to 6% compounding growth from an equity standpoint. And our rents continue to grow 3 to 5% every year. So, when you look at our pro formas and you're getting in on the front end with double-digit cash on cash returns, and then you have a market that's continuing to move through recovery with people moving in, jobs moving in, and historical low interest rates, I don't want to say it's the most mitigated risk I think that you can have is the best way to put it. It's not a perfect storm. There's going to be bumps and bruises if you're a landlord, but we look at, okay, how can we mitigate risk and how can we maximize return? And our investors are mostly Silicon Valley based. So probably a lot of the people that are on the phone, and you're professionals and you're busy and you really are just looking for a freedom of time. And that's what I think we do a really good job at. We're not perfect. Our management company's not perfect, but we have some really good systems in place to give you back a freedom of time. What I tell our clients is 5 to 10 minutes a month is what you should be spending once your portfolio with us is stabilized. Just looking at your statement, if you have a question, you can pick up the phone and call us.
And Brian, you focus on 1 to 4 units, correct?
Correct. We do not build anything above 4 units. We love that niche, and we love that our investors are able to get, single family financing on even 4 units.
Yeah, and I'm sure we have some other brokers on here to talk about maybe 5+ units. And I specialize in apartment buildings, so I can speak a little bit more in terms of the rent. And Marty also wanted me to talk about the cap rates, how this can affect the commercial and multifamily markets. So in terms of the rent, we definitely can see that it will affect the multifamily quite a bit, especially in the Bay Area side. I'm going to share the positive things first. If you're a buyer investor who are interested in doing investing in multifamily, it might be a good time, because you will this coming year, it will be a good time because the numbers, yes, it's not going to look as great because of the rent adjustments, because of all these rent abatement. And when you run numbers, we're based on that. The cap rate. We base on the cap rate and also net operating income. The net operating income is definitely going to be lower. The cap rate right now, that's the question, is like, because the interest rate has been so low, is the cap rate going to continue to be low, or is it going to be increasing? And this is the time where listing agents going to have to do a few price adjustments on these multifamily. And then once, for example, the rent freeze that City of San Jose had just approved yesterday, it will be all the way until December 31st. So right after December 31st, what will happen? Most of the landlord is going to say, I need to increase my rent right now. And so if you're able to kind of take advantage of the numbers that the seller are providing you and then negotiate, you probably will be able to negotiate a pretty good price on a multifamily. I don't know if anyone else would have any comments about this. No? Okay, I saw a hand raised. Who is it? Marty.
Yeah, Helen, the only thing I would say is, based on what I'm seeing on the lending side, so far it's been so early in multifamily that I'm not seeing the adjustment made on the cap rates. But I fully expect to see adjustments made in cap rates throughout almost every property type. Some I think will benefit, like medical office. I think they might compress. I think like a dialysis center might compress. but I can see multifamily slightly going up, and I certainly am going to see things like retail, et cetera, which are problematic, that their cap rates will probably raise. And just for the people on the phone that don't understand the relationship, if the cap rates go up, it means the price goes down. So the key here is if somebody has an expertise in one of these areas and knows how to fix problems or get through the problem period, they'll make a lot of money, but they have to have staying power.
Absolutely agree. I absolutely agree. And that will be another topic also about like what will happen to these different, not only different markets, different asset type that you have to look at. What are you interested in investing in? 1 to 4 units is very different compared to 5+ unit. I see that 1 to 4 units is pretty stable right now, especially in our Bay Area, because if you're buying this as a rental property, your tenant type is likely going to be white collar because it costs $3,000, $4,000, $5,000 to rent over here for a house. So those we saw, we had somebody, a real estate agent who had told me that she manages over 200 units and she only see 4% of the renters had asked for some kind of rebatement, compared to if you're owning apartment building, it ranges from 10% to 30%. So and then you have to look at apartment buildings, what class is it, class A, B, or C, etc. Thank you so much for bringing that up. And question, do you think there's going to be an increase in housing supply? Oh, the increase in housing supply will be much higher than the increase in housing demand once the pandemic is over?
Is that for me or?
I think it's
Open question.
And Weiming will be interested.
Yeah, my opinion in it, and not to be repetitive, but oh. Sorry, are you getting that ring?
Yes, it's okay.
Apologies.
No worries.
So sorry, can you repeat the question?
Oh, I was just wondering if the increase in housing supply, do you think the increase in housing supply will be much higher than the increase in housing demand once the pandemic is over?
Yeah, so again, my answer to that is that it depends on what market, and real estate is so localized. So for us, again, I always go back to the numbers, and I'm constantly asking my management company to update me, especially during this pandemic. Our numbers have not changed. They are the same as they were in January, February, and March of this year. Applications are coming in, deposits are being taken, and our sales are, believe it or not, I mean, our sales in March, the last 2 weeks of March and the first couple of weeks of April have been historically better than they've been over the last year. So we're not feeling it, but again, that's Jacksonville, Florida, so I can't speak about what's happening in San Francisco.
Mm-hmm. In San Francisco, we just now, and that's actually, we show that chart where we see a lot of people are pulling back, withdrawing all the listings, they're canceling the listings. These are the sellers who their intention at first was to sell, right? But because of the shelter in place, they pulled it back off the market. So what are they doing right now, especially in California with the shelter in place, and also real estate is now deemed essential for many counties, not all the counties, but for a few counties. For example, Santa Clara, we allow to show vacant homes, but if it's occupied, we're still not allowing buyers to go in there unless you're doing inspections. And the inspection is also limited to different, like certain inspections only. So a lot of sellers will say, what's the point of putting it on the market if we cannot even show the homes right now? But we probably will see a surge. But in terms of the demand, once I personally, I don't know about other brokers, I personally started getting a lot of buyers asking me, it's like, oh, I want to talk about buying homes now. Although when they talk about offer price, it's always a big chunk below the asking price. So everybody is trying to come in at a discount. Some sellers, if they're in an urgency, then they would definitely negotiate. But then some other sellers like, no, we're not desperate right now, so we can just hold on to the property and wait until the market recovers.
And I can make a comment, Helen, to that, at least as it pertains to our inventory in Florida. I'm partnered with a builder, so on our new construction, we don't negotiate our pricing. And I can humbly say that 99% of our appraisals are coming in over what we're actually selling them at. So the investor's actually getting a discount on the front end anyway. And then with our existing inventory, so not new construction, a home that's been renovated and has a tenant and management in place, we call that like our existing turnkey inventory. Those sellers may be a little more willing to negotiate during the pandemic, but again, the appraisals there are coming in over what we're listing them at anyway. So the investor's getting a good deal to begin with.
Great. And Weiming, I'm just curious, for 1031 exchange, do you see more 1031 exchanges these days? I mean, compared to the beginning, like maybe you can compare the beginning of the year versus last year, and then obviously after this whole shelter in place happened.
Sure, absolutely. So I've been with the previous 1031 exchange companies before in February, and I transitioned to API asset preservation early February. And since then, I think in my first month, I had about 40 or so transactions that opened. So give or take about 10 a week. But now it's definitely slowed down a little bit. I think we're somewhere around 2 to 3 a week. That's, yeah, well, I've also seen some of the data from some real estate firms like Coldwell Bankers, where they were pulling up data. I even took a picture, and I can give you a quick idea of what something like that would look like. They were saying, hey, 2 weeks ago in San Francisco, there were 51 pending deals and 104 closed. But this week, they only had 22 pending and 36 closed. So that's a pretty big difference in just 2 weeks. So it's down like 50%. But I'm also getting a lot of potential buyers asking me about purchases of replacement property. A lot of realtors and real estate professionals can vouch for this too, but I'm sure you have seen a lot of realtors doing those virtual tours. And that's really helpful. In a market where, with Brian's market, if you're buying properties from $100 to maybe $500,000, virtual tour where you may not have to fly all the way to Florida may make sense, right? If the numbers make sense, obviously. But here in the Bay Area, they're probably going for a minimum or average $800,000 to $1 million. And I get a lot of clients commenting saying, I don't know if I can buy something more than $1 million if I have never actually been in it physically to check it out. And virtual tours can show you a lot, but as you also mentioned, with inspections, stuff like that, you just can't get everything like you would, just a couple months back.
Yeah, absolutely. So we see a lot is that the buyers, we went from, Brian, I don't know how well you know about Silicon Valley market in the past couple of years. We went from like no contingency offer. We look at the property for 15 minutes. Yeah, we're making a no contingency offer. These buyers is just like trying to bid for this property, to now it's like, nope, I'm gonna have as long of a contingency as possible until I can get to see it myself. Doesn't matter if the inspection company had inspected this property or not. And everyone is pretty much having a loan contingency because also lenders, you just never know if they're changing guidelines. If any other real estate agent want to comment on that, feel free to see if your experience is the same as ours.
I can comment, at least as again, I can only speak from experience, but as it pertains to our inventory and our investments that we sell build to rent for our clients, and again, a lot of them are Silicon Valley based, it's a new construction product. So I can give you a virtual tour. The home is, for example, you may be buying pre-construction, but then I can take you and show you a virtual tour of the last 200 units that we closed that are identical to the one that you'd be investing in. So your risk is certainly mitigated there. And then obviously it's going to have to appraise. It's going to have a certificate of occupancy. All of our buyers get full inspections, even on brand new homes. But for us, it's sort of cookie cutter because you're buying something that we've already built either down the road or next door, the same exact product when it's a brand new home. And for us in the state of Florida, again, all of our new construction comes with a 2 and 10 year warranty. So your ongoing maintenance and repairs is completely mitigated because you're building or you're investing in a brand new product.
Yeah, that's true. A lot of brand new products, actually, people don't even see it, but they probably trust you too, right? Because you're a builder, you've been building, so people trust your quality. That's why it is probably a little bit better in terms of just doing the virtual tour.
Yeah, I can be honest. I mean, 90% of my clients have never stepped foot in Jacksonville. We have a complete open door policy, so please do come if you want to. But we're in the middle of a pandemic right now, so I don't think anyone's getting on planes.
Well, we are a minute. Oh, well, it just turned 3, but I wanted to say thank you to both of you. But I also want to share another poll with you guys to see if you guys can help me answer some of these questions. The first one is that, how often would you like us to provide these online town hall Q&A? Would you like it weekly, bi-weekly, monthly, or I'm just a webinar out? Oh, it's very similar number. All right. It's oh my goodness, it's same for weekly and bi-weekly. Okay, so I would definitely, the goal before me is that I really want to just educate everybody in terms of like our consumers and our real estate community to share our experiences. So I definitely would love to do this more with you guys. And also lastly, one more question for you guys. What would you like to do or wish to do once this coronavirus pandemic is over? I know some of you is going to say, I just want to send the kids off to the grandparents now. Or if the daycare is open, they will send them off.
I have a 6 and an 8-year-old. I have a 6 and an 8-year-old that are at, my roof is about to blow off my house. They're both boys. So I would definitely say send the kids to grandma.
I'm surprised no one is sending their kids off yet. And well, a couple of people are very happy to stay inside their home right now. And that's hilarious, because to be honest with you, I'm quite content as well to stay inside the house at this point. Well, again, I want to say thank you. And here is last thing I would like to share with you is that, the key to success is often the ability to adapt by Confucius. This is really truly a time where we need to learn how to adapt, no matter of how we work from home, how we learn to be a parent, a teacher, and working from home. All of a sudden we're in social media more. We don't see people as much. But this is ability to adapt, and including investing. You're investing, you need to change your strategy according to the market. And here is Brian and Weiming's contact information. Please feel free to contact them. As you see, they are both exceptionally smart and great real estate experts. I'm sure they can answer a lot of your questions. And I want to thank you all for attending this webinar. If you have any questions, please feel free to contact us. Right now, we are actually scheduled for every other Wednesday from 2 to 3 p.m. And once we have our next webinar, we'll definitely let you guys all know. But in the meantime, please stay safe and stay healthy. Again, thank you so much, Brian and Weiming.
Just in case you forget,
so much.
I'm going to send everybody a survey of, just to give us some feedback on the webinar for next time so we can help improve it. But yeah.
Thank you so much. All right, bye.
Thank you.
Okay.